everybody at this joint CEPR, Graduate Institute, and World Bank webinar. We're very happy today to have Ayhan, Kose, and Franziska Ohnsorge from the from the World Bank. Will present the latest global economic prospects on pandemic and crisis. The Global Economic Prospects, or GEP, is one of the most important publications of the World Bank. It's one of the flagship publications of the World Bank, and this is incredibly timely. It's about the impact on the pandemic in developing and emerging economies. I had read an early version of the report. There is massive statistical work, analysis of past crises, analysis of pandemic. There was a very beautiful review of the report on the Financial Times recently by Martin Wolf. So it's great to have Ayhan and Franziska today to present the report. After the presentation, Nathan Sussman from the Graduate Institute we'll do a discussion, and then we'll open for question and answers. So if you have question, you can use the Q&A function, and also, of course, if you want to talk, you can raise your hand and we'll give you the microphone. So let me give the word to Ayhan, who will start. Ayhan, please.
Thank you again for this opportunity to present June 2020 edition of Global Economic Prospects. Let me start with saying congratulations to the CEPR. CEPR has truly become the one-stop shop for anyone who's interested in analytical work, policy work on all COVID-related issues. I think the center has shown it is muscle by putting together an incredible amount of information in a very short time period to inform the debates and basically provide state-of-the-art analytical work for policymakers as they are dealing with the once-in-a-century crisis. Today, I'm joined by my colleague, Franziska Ohnsorge, and we are going to present our findings from the latest report we released on June 8th. The report has the usual global and regional outlook chapters. In addition to these chapters, it has a number of analytical pieces looking at the pandemic from different angles. One angle we look at is the historical perspective. How different is this one in terms of its magnitude? Another angle we look at, especially important for emerging market developing economies, the angle of informality. We look at the long-term implications of the pandemic, and we also analyze how cheap oil could affect growth outcomes in the near future in the midst of a pandemic. Throughout the presentation, I'm going to use this acronym, EMDEs, Emerging Market and Developing Economies. To structure the presentation today, we are going to focus on 4 questions. First, what are global growth prospects in the near term? Global economy is experiencing the deepest and most synchronized recession since the Second World War. This is the first recession for emerging market developing economies as a group on record. The second question, the outlook is dire, but what are the main risks to this dire outlook? The message there is very clear. Risks are still tilted to the downside, and the main risk is a more protracted pandemic. Third question, what are the likely long-term implications of COVID-19? It is all natural. We have been focusing on short-term growth prospects, but this pandemic will have long-term implications. It's likely that we will see weaker potential output, weaker investment, and weaker productivity over the long term because of the pandemic if policy measures are not put in place urgently. And finally, what are the policy priorities? And there, the single most important priority is to address the health crisis at hand. And then, looking beyond the crisis, it will be critical to implement reforms to reignite growth. In this context, coordinating policies globally is critical. I'm going to focus on the first two questions, and Franziska will take on the last two. Let me start with the first question. What are global growth prospects in the near term? Now, global economy has experienced crisis before, has also experienced health crisis, but never in history policymakers put in place such unprecedented measures to contain a crisis, in this case, the pandemic. These measures translated into dramatic changes in our behavior in workplace and everywhere else. For example, wide range of measures in the shape of school closures, event cancellations, work closures, travel restrictions have been put in place by governments around the world. These measures were necessary to get ahead of the pandemic. They ended up affecting, in some cases, almost all countries in the world. The implications of these measures manifested themselves in mobility indicators. Here on the right, you see how mobility indicators show an outright plunge in activity in terms of work, in terms of transit transactions, retail transactions, groceries. We all felt these changes in our daily lives. The implications of these measures and the sharp plunge in mobility indicators have also been reflected in activity, in trade, in financial flows, in commodities. Here, there are some simple figures showing outright declines in multiple indicators of activity. In most cases, these declines are the largest we have seen in human history. Now, against this background, we looked at growth prospects in the near term. Our forecasts suggest we will see a sharp decline in output this year. At the global level, we are expecting growth to be around minus 5.2%. Of course, advanced economies will see even a larger contraction by 7%. Emerging market developing economies will contract for the first time since 1960 by about 2.5%. If you look at the regions, across the regions, there is clear bleeding in activity. In East Asia Pacific, a region that typically delivers growth around 6%, growth will be around 0.5%. And that region will be the only region that will see an expansion this year, albeit a very small one. This is driven by China, that experienced the pandemic before other countries and has been so far able to contain it. China will grow by about 1%, and it will be the only major economy that will likely see growth this year. In other 5 regions, the story is quite different. In some regions, we will see historical contractions. One of them is Latin America, Caribbean, a region that relies on commodities, that relies on tourism revenues, that relies on remittances, and that trades with large economies, including the United States, Euro area, and China intensively. We are expecting Latin America, Caribbean to contract by about 7.2% this year. Some other regions, like Europe and Central Asia, Middle East and North Africa, and Sub-Saharan Africa, all regions that have a number of commodity exporting economies will see record contractions. A region that has no commodity exporter, South Asia, will also contract after decades of expansion as the largest economy in the region. India will see a sharp contraction in output. Next year, we are expecting growth to come back. But growth numbers for next year will not be sufficient enough to compensate the loss in output we see this year. I will say the expansion we are expecting next year is modest. So it is important to put these numbers in historical context. There, we looked at the data since 1870 and identified what we call global recessions. During these episodes, global per capita GDP contracts. There have been 14 such episodes since 1870. This episode in 2020 will be the fourth deepest one, and it will be the first one solely triggered by a pandemic and measures to contain it. Now, among these four deepest episodes, two of them were associated with wars. The one in 1914 and the one in 1945-46. This episode is the deepest since the 1945-46 episode. But at the same time, it is the second deepest if you take out those that were associated with wars. In a nutshell, we are facing an episode, second deepest after the Great Depression over the past 150 years. This episode is also notable because of one important characteristics. It will see the most synchronized collapse in global output on record. This year, the fraction of economies that will experience contractions in per capita output will be the largest, even higher than what the global economy saw during the height of the Great Depression. An important driver of growth and poverty reduction around the world has been global trade. Trade has been slowing down prior to the pandemic. And if you look at forward-looking indicators, those indicators literally collapse, including new export orders and container shipments. We are expecting a record contraction in global trade this year, more than 13%. It will be a contraction even deeper than what we saw during the global financial crisis. Let me turn to the second question. What are the risks to this outlook? There are multiple risks down the road, and these risks are tilted to the downside. In the near term, the risk of a deeper downturn is there. And that deeper downturn could be driven by a wide range of reasons. The single most important reason, we might end up with a more protracted pandemic. This crisis started as a health crisis. It turned into an economic crisis. And there's a possibility it will trigger financial crisis amid high debt levels in many economies. We cannot rule out the possibility of re-escalation of trade tensions among major economies. Policymakers reacted with force to the pandemic and put in place large-scale fiscal and monetary policy measures. But effectiveness of these policies could be limited as we push them forward. That could also lead to a weaker recovery as well as a deeper downturn. Over the medium and long term, we might see a weaker recovery and weaker output growth. These could be driven by depressed commodity prices, and the longer-lasting effects of the pandemic on households and firms. There is the possibility of deglobalization in the form of fragmentation and retreat from global value chains. As Franziska will discuss, there is the issue of larger than expected adverse impact on potential growth down the road. When these types of deep crises take place and incomes collapse, social unrest tends to follow, and that possibility is there. Of course, we are worried about weaker development outcomes as well. I talked about the single most important risk is more protracted pandemic. When you look at the number of daily cases, you see advanced economies now are simply on the other side of the curve. But the numbers have been picking up in advanced economies as well, primarily because of the increase in infections in the United States. If you look at emerging market developing economies and take out China, they are in a steep curve. Some regions are more than the others, see a steep increase in the number of infections. These regions include Latin America and the Caribbean, South Asia, Sub-Saharan Africa. These are the regions. There are serious limitations in health services and testing capacity. The bottom line is that we might be underestimating the gravity of health crisis in those regions. Now, obviously, we are going through a period of extreme uncertainty. This uncertainty manifested itself in different forms. If you look at downgrades in forecast over the past 4 months, you see something remarkable. We basically witnessed the fastest and steepest downgrades in global growth projections when we compare them with previous such episodes, including those, the 1991 global recession and 2009 global recession. The question is that whether these downgrades will continue in the near term, as much as we have seen some stabilization in forecasts in recent weeks. Against this background of uncertainty associated with growth forecasts, we also looked at some possible scenarios that take into account downside risks as well as upside risks. Our baseline forecast assumes that most countries will start normalize its economies in terms of these containment measures after June. But that might be an optimistic assumption. The outbreaks could continue. We might even see a second wave. If that takes place, we will end up with our downside scenario. That scenario implies global growth could go down to 8%. Under that scenario, advanced economies will see growth minus 10%, and emerging market developed economies will contract by about 5%. There is also the possibility of basically stronger measures implemented, activity normalizing faster than what we are expecting in the baseline, and containment measures are effective. If that scenario materializes, that will be reflection of an upside risk. Under that scenario, growth outcomes will be better, but still the global economy would contract by about 4%. That will be 2 times larger than what we saw during the global recession. Again, there is unprecedented uncertainty around the baseline. It's manifested in the dispersion we see in consensus forecasts for global growth. Now, the big issue is not just the short-term prospects. When global economy will go back to pre-trend output levels. When you think about that question, the first element you explore is what will happen next year in terms of growth. On the left, you see that the projected growth numbers for next year will not compensate the losses we see this year. There will be still very large losses relative to pre-crisis trend. On the right, you see that the trend output level will be impossible to achieve in the near term after the plunge global economy is experiencing this year. Global economy experienced a sharp decline in output during the 2007-2009 crisis. And the 2009 global recession translated into losses global economy still did not recover from. In all likelihood, we will see a similar outcome. Let me turn to Franziska to discuss the details of long-term prospects.
Before you go to Franziska, just one quick, so we are getting a lot of questions. I'll get to you and Franziska after Nathan's discussion with these questions, which are very interesting. So I ask all the people who are asking questions to keep asking, but be patient. We'll get to them. Franziska.
Thank you. Yeah, Ayhan already told me that this is the deepest global recession since the Second World War. Now, if history is anything to go by, this will do lasting damage. Even we know from a lot of research since the global financial crisis that these big crises lead to lasting output losses. And that's exactly what we showed. So here in this exercise, we did a local projections model where we estimated the long-term effect of recessions and financial crisis, and actually oil price plunges too, which is not shown here, on potential output. We deliberately didn't want the zigzag of actual output, so we focus on potential output. And we find that recessions since 1982, all the recessions since 1982, and 95 emerging markets and developing economies, have been associated with long-term output losses 5 years after the recession of about 6%. We did the same exercise with financial crises, and we found that 5 years after financial crisis, there were also output losses, smaller. And that's in large part because these are the Laven Valencia financial crisis. So more than half of them are currency depreciations. And a lot of them are actually not even associated with the recession. They're not even that disruptive. Now, if you look at the chart on the right, you see what a combination of recession and financial crisis does to potential output 5 years later. So 5 years after, so that's about a quarter of the financial crises that are actually associated with recessions. So 5 years after a recession that comes with a financial crisis, potential output is still 8% below baseline. And these effects, we all know, they work through hysteresis. No, they work through employment, long-term employment losses that lead to loss of human capital. They can discourage investment until the dust has cleared and investors are a bit more certain about growth prospects. So if these past recessions are anything to go by, then this really severe global recession is going to do lasting damage to potential output for many years to come. Now, of course, the first response is you can't compare this recession with any of the others, any of the previous ones since 1980, because this time is different. And in a way, that can be said about every global recession. No? They're all triggered by slightly different things, but this one is indeed the first, as Ayhan said, it's the first to have been associated with a global pandemic. We don't have data for this exercise all the way back to 1918. Otherwise, we would have loved to estimate it for 1918. But what we can estimate is the impact of less global epidemics on labor productivity and investment, again in a local projections model. this time for a slightly broader sample, 135 emerging markets and developing economies since 1960. Now there have been actually there have been 5, but we drop 1. So there have been 5 epidemics that were not global, but that were regional, affected several countries and that were severe. So it was SARS around 2002-3 in East Asia and Pacific. That was MERS in the Middle East and Asia in 2011, 12, 13. There was Ebola in 2014-16 in Africa. And there was Zika in 2015-16 in Latin America. Of course, there was also the swine flu that I'm sure most of you have totally forgotten because that happened in 2009. So we can't disentangle the effect of the swine flu from the effect of the financial crisis in 2009, so we remove it from the sample. But these other epidemics didn't have such strong compounding effects. So we test, what does the local projections model tell us about investment 5 years after these 4 epidemics? And we find that even 5 years later, investment is still 11% below baseline. Labor productivity is still 6% below baseline, as you see in the chart on the right, significantly below baseline. So these past epidemics have all done long-term damage to macroeconomic outcomes. And if anything, we expect this global pandemic to have an even more severe lasting impact for 3 reasons. First, this one's global. It's not just regional or local. It's a global pandemic, so it's very difficult to see the world returning to normal until all the major economies are past it. And as Ayhan showed you in the chart, they're not. Many of them are still in the middle of it. Second, this pandemic hits the global economy at really the wrong time. Already we have behind us, even before the pandemic, we just had behind us a decade of growth disappointments. We just had behind us a decade of declining potential growth, declining investment. We expected this, we saw no reason to not expect it to continue for the next decade. So we expected global growth to continue further, to decline, we expected global potential growth to continue declining over the next decade. 2019 was the year with the lowest post-crisis global growth and the highest, actually record high, global debt. So this pandemic has hit the global economy at a very weak time. And third, this pandemic is chipping away at what we know to be the drivers of long-term growth in a lot of emerging markets and developing economies. So yes, there's a disruption to human capital. So 90% of the world's children have at some point in the last 2-3 months had their schooling disrupted. You see that in the chart on the right in that orange line. But there's also this concern that it'll undermine global value chains, which really have been a conduit for productivity transfer and technology transfer to a lot of emerging markets and developing economies. And that it undermines tourism, which for many of the smaller countries is really a lifesaver. This is the main source of income for some of the poorest and smallest countries in the world. So this global pandemic is really eroding long-term growth prospects. Now, what does this mean for policy? Let me first step back and just show you the policy challenge that emerging markets and developing economies really face in this. So as you see, about 20% of EMDEs, of global exports are produced, the value added of global, 20% of the world's exports is produced by EMDEs. If these global value chains contract, they return to their home countries, that is going to be a blow to EMDEs. You see how much small states rely on tourism revenues, about 10% of GDP. You see remittance flows account for about 8% of GDP in Asia and in Europe. Now these remittances flows are really disrupted by the restrictions that governments have put in place that Ayhan showed you. And finally, a lot of emerging markets and developing economies depend on commodity exports. There is an extra, so there are some advanced economies too that have the same vulnerabilities, but there is an additional concern in emerging markets and developing economies, and that's widespread informality. 30% of GDP in EMDEs, 70% of employment in EMDEs is informal. And that has 3 implications. First, it becomes very difficult to contain the spread of the pandemic, because in the informal sector, working conditions tend to be very crowded. Only in the 1/3 of EMDEs with the highest, most pervasive informality, just about 1/3 of the population has access to sanitation, clean sanitation. Less than half have access to hand washing facilities. It's difficult to contain a pandemic when you don't have this basic sanitary infrastructure. Second, governments cannot reach the poor. What governments in advanced economies have done, put in place huge economic stimulus to support the vulnerable groups. Very difficult to reach in EMDEs because the informal sector usually has no access to the formal financial system, for example. It's not recorded in tax registries. For example, of informal firms in the average EMDE, only a quarter hold bank accounts. Most of them work in cash. It's difficult to reach them. And of course, the countries, informality is a symptom of broader development challenges. So countries with high informality also have very weak healthcare systems. So people that do get sick are really difficult to treat. So what have governments done in EMDEs? They've done a lot. They haven't done as much as in advanced economies, but they've done more than they've ever done before. So fiscal stimulus averaged 5.4% of GDP in EMDEs. That's more than twice of the stimulus they implemented in global financial crisis. And a lot of EMDEs have put in place aggressive monetary policy loosening. So they've done interest rate cuts, and a lot of, actually at least 13 EMDEs have put in place QE, quantitative easing, mostly for financial stability reasons, not so much for stimulus reasons, but financial stability reasons. So that's a very interesting experiment, policy experiment, and it'll be interesting to watch how it unwinds. And that was exactly the right thing to do. This was the urgent, this was what was needed, deal with the health and economic crisis. What has been, where there's been a bit less progress made was in what is important beyond the urgent. The forward-looking policies that make sure that there's a strong recovery, that there's a return to robust growth. So I won't go through all the details here put in this slide, but there is a need to boost potential growth again. Even before the pandemic, there was a need, and good policies for growth before the pandemic are mostly the good policies before the pandemic, for long-term potential growth after the pandemic as well. So there is a need to boost that policy, those policy initiatives. Now, just to summarize, what are global growth prospects in the near term? Very bleak. So this is the deepest global recession on record since the Second World War. And if anything, the risks are still to the downside. It's likely to have long-term implications beyond the near term as well. So while a lot of progress has been made on the urgent reforms, not that much has been made on the long-term reforms to boost growth. Now, this recession, like many others, has been accompanied by a lot of discussion of the shape of the recovery. So there's an alphabet soup of letters that describes it. There's also two more innovative ones like the bathtub and the Nike swoosh. But really, the shape of the recovery defined in this way, it depends entirely on your technical assumptions. So in growth rates, most of the 14 global recessions that Ayhan showed you are actually these. And in terms of pre-crisis trend, most of the global recessions that he showed you in this slide are actually bathtubs. And if you define in terms of pre-crisis output levels, you get just any number of shapes. So the same recession often has 3 different shapes. What our main takeaway is that this will not be over very quickly. We will be dealing with this, with the repercussions of this recession for many years to come. And thank you. With this, I hand over. Actually, a little bit of advertising. So it says there's the JEP, which this one showed. This presentation is all about. We also do the commodity markets outlook twice a year. Since 1970, we've done this. And this latest issue was also dedicated to COVID-19. We do high frequency monitoring, and we've published 2 books that show in November and December already how poorly placed the global economy was to suffer the next global recession. And with this, I hand over to Ugo.
Okay, thanks a lot, Franziska and Ayhan. We have a lot of questions, but before that, so bear with us. We have a discussion by Nathan Sussman. Nathan is my colleague here at the Graduate Institute. He's professor of economics. He's also the director of the Center for Finance and Development, who has been helping us organizing this event together with CEPR, of course. So, Nathan?
Thank you, Hugo. Thank you, Francesca and Ayhan, for an interesting presentation. I read the report almost cover to cover, and so I have a few general comments, and I'm picking up on the line that Francesca had about, is this time different? Offer a couple of comment suggestions, and then maybe talk about opportunities, not just about the damage that's already done. So in terms of comments, and I think this was alluded to in the presentations, is that we're facing not only the first global health crisis on such dimensions since the Second World War, but it's also something which, as an economist, I find intriguing. It's an exogenous lockdown of the economy. Almost all the other crises, including the pandemics that occurred in Asia, SARS and Ebola and so forth, did not involve a complete shutdown, exogenous shutdown, lockdown of the world economy. And in this sense, this is peculiar. It's a very unique event, and it's not endogenous to what was happening in the economy. So if we put it in terms of the financial banking type of framework, so are we facing a liquidity crisis or a solvency crisis? In the sense that we're shutting down the economy is not operating, we're taking this very long vacation, but we're out of liquidity, or are we getting into some solvency crisis where some of these things that occurred during the lockdowns eventually impact the possibility for recovery?
So basically I was pointing out that the difference between an exogenous lockdown versus an endogenous lockdown of the economy, and how does that affect the dynamics of the crisis? So obviously, we've seen from the report that when you have this total global lockdown of the economy, so the short-term dynamics are very severe, they're very abrupt, and that's why it shouldn't be surprising that we see a very quick descent in terms of all the economic indicators we're looking at, whether it be GDP growth, trade, and so forth. The second question relates to whether there's some difference in the recovery process from a liquidity crisis and a solvency crisis. So if it's a liquidity crisis, you might expect a faster recovery than if it's a solvency crisis. And then, again, this is something that I think the report could have made more explicit in terms of the discussion. And finally, that relates to structural change, is whether this health crisis, this pandemic, bring about a negative or a positive structural change in terms of assessing the long-term process. So obviously, the time the economy was shut down is lost time. So we're not going to compensate for a lot of the things that we didn't do over the last 2 or 3 months, depending where you are. But the question is, moving forward, are we seeing a sort of a structural change that will lower productivity? So these are kind of questions that the report raises, and I think need further discussion. And I think that one of the key findings of the report is to look at these things. The report also mentions, and this is also very unique, is this unprecedented policy response. So even on the monetary front, we've seen more of the same in terms of what was happening in the global financial crisis. But again, this was the speed of the response was unprecedented. The expansion of balance sheets of central banks was at a rate much faster than we've seen during the global financial crisis. But also fiscal response was unprecedented, both in the advanced economies and some of the emerging markets, developing economies. And again, this unprecedented response will affect the dynamics of the recovery. And therefore, should we look at previous crises where we didn't have such a response and compare that those recoveries with what we might expect now? Again, this is a question that we should think about. And finally, and these are things that are going to move forward in terms of this few minutes I have, is to talk about some silver linings that we might have in this unfortunate crisis. So one silver lining or one surprising, could be surprising outcome, and this is taken from a work that Rui Esteves and myself did recently and was published in the CEPR book edited by Hugo, is that emerging markets, financial markets, stabilized fairly quickly compared with previous crises. So we have a number of indices here, world stock prices. You can see that the MSCI emerging markets pretty much tracks the MSCI world. We see the creation of emerging markets currencies was swift for about a couple of weeks, but then stabilized, and now it's returning. And also in terms of bond yields, we see that the EMDE index, after a very sharp increase in the spreads, is basically going down. And this is occurring at the same time that the pandemic is actually expanding to these markets. So we have this kind of scissors movement as contagion goes up, financial markets seem to be going the other way. Now the question is, are these financial markets thinking that we have achieved some financial resilience due to the monetary policies taken by the major central banks, or is it irrational exuberance? And again, this is something that only the future will tell. But maybe markets are also thinking that this time might be a little bit different in terms of the effect of the policy response, at least as financial markets are concerned. Another interesting thing to look at is what can we learn from China? So obviously, China was almost the first one hit, and also one of the first ones to recover. So now we're seeing a slight uptick, but in general, it recovered. So instead of focusing on the world economy and on history, we might think or try to look at what's happening in China. And here, this is kind of a mixed picture. These are taken from the OECD monthly economic indicators. These are published monthly and obviously subject to some noise. But if we look at this figure, we can see that if we looked at Chinese exports, which is the black line on the top, we can see that they suffered a decline, a recover, and are pretty much at levels that they were before the crisis. If we look at the Chinese Business Confidence Index, which is taken again from the OECD Composite Leading Indicators, we see a sharp decline. That's the red. We see a sharp decline and then a recovery, which is actually, I don't want to make too much of this final point in the data, but it's actually higher than the pre-crisis period. And then if we look at the composite leading indicator that the OECD publishes, then there was a severe drop and a recovery. True, we're not up at the pre-crisis levels yet, but this is it's a V-shaped recovery as opposed to a U-shape or some other bathtub type of recovery. So again, just focusing on one country that it's a large country, it's a huge economy that went through the crisis first and recovered first, we might have a glimpse into what the future might be for some other economies as well. Now, looking at some opportunities, so this unprecedented fiscal support that was handed out during this crisis and still is still coming can be used not just to provide the safety net and liquidity provisions for businesses and consumers, but also to provide growth-enhancing opportunities to actually exploit this sort of unprecedented situation of fiscal spending together with extremely low interest rates to actually move forward some investments that are either long due or would have occurred anyway. So a lot of organizations, the OECD, IEA, and others are emphasizing this Green New Deal concept, where you move forward investments in renewable energies and sustainability. And those type of investments can also benefit lesser developed economies in the sense that increasing investments in these technologies makes them cheaper, affordable, and these are the kind of things that might help lower income economies, not the oil exporting ones, but obviously all the other ones. Human capital formation. Okay, so we can think about the crisis as causing some severe damage to human capital formation. But actually, again, as a professor at university and the type of webinar we're having right now, this online panel discussion, might suggest that there are some advantages that we can take away from this remote learning experience. And remote learning can actually provide higher quality learning to almost anyone on the globe that has an access to the internet. And we're becoming better at this, both in terms of the platforms that we use and also in terms of our experience in dealing with these things and developing teaching methods and so forth. So this is something that's actually an opportunity for people living in remote parts of the world with no access to top universities or top high schools and so forth, that can actually, given an investment in ICT infrastructure, obviously, can actually improve things and increase productivity, make quality education accessible for many more people than it is currently. Other things that we can think of are productivity enhancements. So again, the teleworking and conferencing of the sort we're doing now can be considered as productivity enhancing, and we can, again, we don't want to shift completely to teleworking and online webinars, but actually these are the kind of things that can increase productivity, and these are positive takes away. Another thing is development of robotics and artificial intelligence. Obviously robotics don't get the virus, they don't get sick, and so forth, and especially in hazardous occupations, there might be an incentive to use them much earlier than we would have thought otherwise. So this is something that actually could speed up investments in these types of technologies. Finally, there's the public health issues. Part of it is technological. I think that the crisis will eventually, I mean, hopefully we get a vaccine, but I think will also increase our capabilities at home testing of viruses and so forth, tracking. All these would be low-cost solutions for future epidemics. So we're paying some learning costs right now, but I think these things could actually minimize the impact of those kind of things in the future, and they're relatively low cost and could be adopted also by lower income economies, not just the more advanced economies. Finally, spending on healthcare will strengthen healthcare system around the world. I think that in many countries with a lot of inequality and between rich and poor, I think that the consequences of having a poor healthcare system for the rich because of the lockdowns has actually made it clear to them that they should invest not only in their healthcare systems, but in providing some general public healthcare system, because in the end, it affects everybody. Maybe not their personal health, but their economic health for sure. Vulnerabilities. So the report talks about vulnerabilities, and I'll just stress them because with all these positives and things we can do to make things better, we have to worry about certain things that could go the other way. And one of them, which the report makes talks a lot about, and I think it's really crucial, is protectionism. We've seen that the crisis has affected the global value chains, the reduction in world trade, and we just have to make sure that this doesn't turn into protectionism after the crisis is over. So this is something we should be really aware of and be really pushing to avert. The other thing is that a prolonged crisis without sufficient liquidity provisions could affect banking systems. So in some economies, for instance, where the government sent SMEs to the banking system in order to borrow, providing some assurances, this could put some stress on banking systems. And so far we've seen that the crisis, unlike the GFC, did not turn into a banking crisis or like the Great Depression. And we should really be careful of preventing this from happening in this crisis as well. And finally, there's the issue of tourism, which again, the report talks about a lot, is that unfortunately, most of the losses made in the tourism industry and are still being made and will probably linger a little bit longer, are not recoverable. And we have to think about how do we compensate or how do we help the people in those industries survive the next year, because these things are not recoverable. The vacations that were not taken were not taken. And so this is something that we have to really worry about, because in some economies, these are relatively large sectors. Finally, getting to the issue of finance and development, the center I am directing, I think there are also some opportunities. unfortunately, due to the crisis, perhaps interest rate normalization has been deferred. So we've seen in the US and the interest rates go down, and we've seen projections in terms of forecasts that the interest rates are not going to increase anytime soon. And this is actually something that once the health crisis is over, works to the advantage of investing in emerging markets and developing economies because of the higher return what can achieve in those economies, and given the huge amounts of funds in pension funds and so forth, that again, once the health system crisis is over, I think are still there and are ready to be invested. The other thing, as I said, is the Green Deal investments, that those will also benefit lower income economies, because these technologies, the investment in these technologies provide lower cost for energy generation, and therefore we can see more potential for growth in these economies that are energy poor because they're dependent on oil. So these are some of the upticks that we can think about in terms of finance and development. Okay, and with this, I'll end, and thank you.
Okay, thanks a lot, Nathan. So now we have lots of questions. So Franziska and Ayhan, I'll try to group some of them, and you answer them, or you disregard them if you don't want to answer to them, and if you also want to say something related to what Nathan said, of course feel free to do it. Let me start. There are a bunch of questions that focus on measurement. So the first question that was asked by Mia Mikic, so this is the first question came in, so it's going to be the first question I'm going to ask. After that, I will not go chronologically, but is that should GDP be the right metric we should worry about? So that's one question about measurement. What metric? And that's a question, that goes on for a long time, whether GDP is a good measure of welfare or not. And then there are two questions about measurement more of the health impact. One is from Riccardo Puglisi from the University of Pavia, who is asking whether we should focus more, rather than on measuring cases, in measuring death, and even more measuring ICU occupancy. So that, which just tells how much are we able to do this. And still related to measurement, there is a question from Amin Kebe from the World Health Organization, who is saying that he's truly concerned about Sub-Saharan Africa, because if I understand correctly, his question, the data are particularly bad. So the situation might be much worse than whatever data we have. And so he's worried about a dramatic outbreak. So maybe you can start with these three, and then we move to others.
Thank you, Ugo, and we thank Nathan for this discussion. I very much appreciate his discussion, because he covered a lot of material we have in the report, but we did not cover in our main presentation. Before answering these questions, let me say quickly three things Nathan alluded to. I think the first issue, whether this large-scale policy response has helped so far and will help in terms of driving the recovery. The answer is basically a qualified yes. In fact, in our scenarios, we looked at what will happen, the growth outcome, if the policy support wasn't there, and growth outcome would be much worse than what we are projecting now. Of course, this large-scale policy response, as much as it is necessary, will sooner or later be withdrawn. And there, it's going to be critical to have the kind of the frameworks to normalize policy. This is an important issue in the context of emerging market developing economies. The second issue, Nathan basically discussed this financial market response. There are two aspects when we think about the movements in financial markets, especially equity markets. The first one, what is going on? Why these markets are decoupling from the real economy, given that we have these dire projections? And I think the second question is that, as Nathan put it, is this an indication of resilience in the context of emerging market developing economies? Let me briefly touch on both of those. In the context of decoupling of financial markets from the real economy, there are, I think, good reasons why we see this exuberance in financial markets. These good reasons do not necessarily justify the valuations we see. First reason is that obviously markets are betting on a much faster recovery and normalization of containment measures. Second, let's face it, central banks basically provided a backstop they have never provided in history. There is very large liquidity in the system, and some of this liquidity obviously finds its way to financial markets, especially equity markets. And the third issue is the sectoral dynamics. When you really look at deep down and analyze equity market movements, you see that those sectors relying on basically technology will they register the largest gains relative to other more traditional sectors: transportation, retail, restaurants, tourism. Now, as I said, time will tell whether these prices are basically justified by fundamentals. The second question, whether it just shows the resilience in emerging market developing economies, our answer is no. We think that there are serious financial challenges in emerging market developing economies. The hope is that those financial challenges are not going to turn into a crisis, as we have seen many times in previous episodes. Each crisis has this twist and turns. Here, we start with a health crisis, as I mentioned, it turned into economic crisis. Whether it will turn into a full-blown systemic financial crisis has to be seen. But emerging market developing economies came to this crisis much weaker than what they had prior to the 2009 global recession. They had larger vulnerabilities in terms of debt and deficits, and of course, they had larger vulnerabilities when it comes to their policy frameworks. Finally, one question Nathan mentions, China. What can we learn from China? I think China is different in many respects. I would say it has still ample policy space to respond when it comes to fiscal and monetary measures, as much as the financial risks are there. The most important thing I think we learned from China is how to contain the pandemic. And it starts with testing, isolating, and treating as early as possible. And China has done that quite well. Pandemic also brings these issues in the context of climate change, in the context of technological change, and in the context of investing in human capital. So in the context of climate change, there is a very simple lesson here. Tail risks are there, and they do materialize. If we had this discussion a year ago, I think we would say the likelihood of pandemic is minuscule. Now, there are a number of policymakers out there, they think that climate change related risks are minuscule. But those risks are real. They can turn into a very large disasters. That means whatever policy measures we are thinking, we need to take into account implications of those policies for climate. We need to have green policies in place. The second issue, technological change. Yes, we basically provided a dire picture here in terms of short-term prospects and probably long-term prospects as well. But there is the possibility of a surge in technological innovation and a surge in productivity growth because of intensive use of digital technologies, as we have been doing over the past 4 months. This has to be seen, but we are hopeful it will happen. Has it happened so far over the past 2 decades? The answer is no, not in productivity statistics. The hope was that these technologies will become general purpose technologies. Maybe this crisis will facilitate that. And finally, I think the investment in health is critical. And health is something related to human capital formation. And the hope is that the investment in health sector will translate into faster human capital formation in coming years. Now, let me turn to these 3 questions very quickly. Is the GDP right metric? I think that if you want to look at cross-country activity, if you look at activity over a long period of time, GDP is still the metric we have. Is this the perfect metric? Probably no. And I think that we will have better metrics in the near future, but ultimately we need to have comparable series over time across countries to use. Measuring cases in terms of deaths and IOU capacity, this is an important issue. But at the end of the day, we need to worry about number of infections, because if infections increase, containment measures will come. With respect to Sub-Saharan Africa, our growth forecast this year is close to -3%. If the downside scenario materializes, it will be much larger. The region is experiencing a sharp increase in number of cases, so downside risks are there. We are worried about prospects in Africa. But let me stop there.
Okay, so I see behind your head the waves of dead books that was mentioned by Franziska. So we have 2 questions about that, which was briefly mentioned by Franziska. So there is a question from Will van der Lande and a question from Silvia Marchesi, and they're both basically asking what are going to be the implication of this crisis for debt service and debt sustainability, especially in low-income countries. And if I think of your waves of debt books, it looks like this is a tsunami coming.
Yes, we worked on that book, Ugo, and thank you for all the feedback you provided. We of course, extensively used your work as well. Let me turn to Franziska. We worked on that book together to answer these questions. Franziska?
Yeah, the tsunami is coming, but it had started long before. I mean, even at the end of 2018, that was already at a record high of 170% of GDP, unprecedented high. So this just adds now to the pressures. While the financial markets conditions are so benign, as Ayhan was saying, and while a lot of the low-income countries, well, half of the ones who qualify, have this temporary suspension of debt service, it's not so obvious that this large stock of debt is a vulnerability. But of course, the minute financial market conditions tightens, it becomes a big vulnerability. And what we did in that debt book also, we checked how many of these debt buildups were associated with financial crisis. A large number of them is. Some are financial development, but really when you have this broad-based debt buildup, you usually have a series of financial crises. So what we pointed out in the book is that there have been 4 broad-based debt buildups since 1970, and the last one was just the 4th. But all the other 3 ended in broad-based crises. 1970s, 80s, we had a lick crisis and a LAC crisis. Then we had an East Asia crisis, then we had in Europe a crisis. So even without the pandemic, high debt constitutes a risk. The pandemic makes everything harder.
Okay. So, so you talked a little bit. We talked a little bit about China. There is a question about the second largest country in the world by population is India. So how do you see the prospects for India? This is a question from Jessica Singh.
Yeah, for India, obviously, like other countries, activity deteriorated dramatically, and the government put in place very strict lockdown measures. Now those measures have started to normalize recently. but the economy is going to go through a very rough period. We are expecting the economy to contract by about 3.2% this year. And in the case of India, given the number of infections, downside risks are quite sizable. We expect the economy still to turn to growth next year and deliver around 3%. The important point is that these numbers, of course, much lower than what India can deliver. But the pandemic is, by its very nature, global, and in the case of India, limited health service and difficulty of implementing containment measures and difficulty of implementing the types of policy measures you see in many countries because of the reasons, Franziska listed, including rampant informality. The challenges are there for India.
There is one question is that what could country, developing countries, some of them characterized by poor governance, high level of inequality, high level of informality, what's the best way so that the limited resources that there are directed, are targeted to people who really need it? So this is a question from Saleh Sadiq.
Yeah, so let me turn to again Franziska, who basically worked on low-income countries in different contexts to provide an answer to this question. Franziska.
Yeah, that's also something that has been tried in countries such as India, how to give the economic support. And just one more thing on India. You have to bear in mind, India has enormous informality, as Ayhan said. Now, all these restrictions, these government restrictions, hit the informal sector because they hit services. So 3/4 of firms in the services sector are informal. That compares to about 1/3 in the manufacturing sector. So by shutting down services, you're hitting the informal sector. Now, the informal sector doesn't use bank accounts. The informal sector is a no-tax registry, so it's incredibly hard to reach them. And countries have actually tried innovative new things. So they've tried to have like open food deliveries. A lot of poor countries have tried in Latin America, in Asia as well. They've tried cash payments, just direct cash payments. They've tried digital transfers. So there's a lot of trial and error, and it'd be interesting to take stock of how effective these things have been exposed, once we all recover and we gather the data to see what happened.
There is a question about that you also discuss in the report about the effect of oil prices. It's interesting that in a region like the MENA region, so you have some countries that produce oil and of course are affected negatively by the low oil prices, but also countries that import oil like Jordan or Lebanon, which is already in a crisis on its own, end up being affected negatively because even though they're oil importer, they have a lot of workers which do work in the Gulf. They get a lot of remittances. They get tourists from the Gulf. So can you tell us a little bit? So there is a question about the impact of oil prices on this crisis.
So obviously, these economies that rely on oil had a major shock when we saw this, the plunge in oil prices during 2014-16, and their fiscal balances deteriorated dramatically during that episode. Now, this shock brought something historical with the pandemic, and the prices plunged to record lows. Demand dried up at some point before the agreement of OPEC plus. There was the expectation of market flooded by oil. Those dynamics have changed, but the oil price is still lower than what we saw prior to the pandemic. Now, we are expecting a very sharp downturn in commodity exporting economies, including oil exporters. I mentioned that the downturn this year for emerging developed economies is going to be around minus 2.5%. For commodity exporters, including oil exporters, that contraction will be doubled in our projections, so minus 5%. Some of these economies, of course, in the Middle East, as you mentioned, rely on tourism revenues. Some of them rely on remittances. So in a sense, you have a series of shocks, adverse shocks, hitting these economies at the same time. And the big issue down the road is going to be whether they can contain the pandemic and give the signal that things are normalizing. And in that context, as we repeatedly mentioned, the single most important challenge is to address the health problem and basically get to the other side of the curve as quick as possible. And there really, there is no silver bullet. You basically forced to make a decision between lives and livelihoods, and what is the optimal, point in that decision is a very difficult one. And I think that in most countries there is this tendency to find a solution and then normalize activity while keeping some of these containment measures in place. So far, some economies, some countries have been more successful in delivering sustained declines in, infections, and some countries have not been that successful. In the context of Middle East, North Africa, and the oil exporting economies, we need to see how the pandemic is going to evolve. Of course, the evolution of pandemic will have an impact on oil prices as well.
So Nathan mentioned quickly tourists. For some country, their oil is tourists. So we have a question from Juan Carlos Quiros, who is an economic advisor at the Central Bank of Costa Rica. So he's asking, what can countries like Costa Rica, which are heavily dependent on tourism, and then if you think country in the Caribbean and some country in the South Pacific, even more than Costa Rica, what can this country do to mitigate this massive shock? In this ebook that we edited, we have a chapter that shows that there are countries with basically no cases, but with massive economic costs, because basically these are countries that rely on tourism, and tourism had a mortal blow with the COVID.
Ugo, I think everyone on this panel, Franziska, Nathan, you and I, we worked on extensively what we call small open economies. And there is a tragedy associated with a small open economy. There are certain things you do not control. And in this case, the things you do not control come and hit you, I think, very, very aggressively. And the dependence on tourism is one of them. In normal times, it's wonderful to have these revenues. In this context, of course, even a country contains the pandemic and able to create the safe space, it's going to depend on what other countries are going to do, whether travel restrictions are going to be lifted, because most countries are going to probably try to stop people coming from countries they still have a pandemic on the rise. So the bottom line is that for these countries, the shock is not, temporary. For all practical purposes, the shock will be there for a while. And there's this possibility that if behavior of consumers change when it comes to travel for the foreseeable future, the impact could be deeper, not just this year, but in the next 3 to 5 years. So what is basically the message here in a nutshell? These countries need to find ways to compensate the loss associated with tourism revenues. In some cases, that's possible. They have fiscal space to do that. In some other cases, it is much more difficult. And in some of these poorest countries, Costa Rica is not one of them. That's why the global community put together a debt relief initiative to suspend debt payments and provide at least temporary relief. But the gravity of the challenge is there, and this challenge will require policymakers to be creative. That's why we see so many policymakers around the world are basically experimenting with measures they have not tried before. The question is that how long that experimentation is going to be there, and as we discuss in the presentation, whether these policies, large-scale, unconventional, and rather creative policies, will see their limits in terms of their effectiveness. But let me stop there.
So there is a question from Malek El-Khoury.
Ugo, can I
sure,
add something
of course.
tourism? I just want to add on the tourism issue, putting my former central banker hat on. I guess for countries that are facing a shutdown of their tourist industry and have fiscal space, or especially countries like Costa Rica, for instance, I would have advised them to take advantage of the time that the hotels are shut down to renovate and make their hotels more attractive for future tourism, because tourism will resume. But if you, and in most cases, it's very difficult to shut down a hotel and renovate during when you have the tourists. It's a huge opportunity cost, but it's actually something that you can do right now, make those hotels more environmentally friendly and so forth, and prepare them for the future ways of tourism. So you can take advantage of this lockdown.
Thank you, Nathan. So there is a question. So people who studied economics at our time, Ayhan, they were told that, you know, the big policy mistake of the 70s was to respond to, you know, a supply shock with the demand policy, and this caused, you know, stagflation. And so now we have a supply shock, and we have expansionary policies, and you know, there are no signs that inflation is coming. So this question from Malek El-Khoury is like, how the recovery will affect inflation.
Yeah, thank you, Ugo. As you know, we released this comprehensive study in 2018 on inflation. You looked at some of these chapters. In fact, you and I worked on this chapter, aptly titled Inflation Expectations. This question is about. So the inflation expectations are depressed, but I worked on this book with Franziska Ohnsorge and my colleague John Grimha. I'm going to turn to Franziska. She has been looking into these issues in the context of different countries. Franziska?
Yeah, Ugo, this is not just a supply shock. It's a massive demand shock. It's a huge demand shock. For oil, we've actually estimated how much of it is demand and supply. So we've decomposed the oil price plunge into demand and supply shocks. And we find that 2/3 of that particular plunge is actually demand driven. It's an unprecedented demand shock. But on inflation, so really at the moment, if anything, just given the sheer size of the demand shock, in the short run, the pressures are for disinflation, not for inflation. The question will come in the long run, no, is how much is social distancing, or how much are behavioral changes by firms and by people going to suppress demand versus supply? It's really difficult to say. But I think, okay, let's leave it at that. Let's leave it at that. So really, it's hard to say. It could go either way, that you can get inflation or that you could get continued disinflationary pressures. If you think of the potential growth slowdown that is in the works anyways, that around which the pandemic is nothing but noise, you would think that unless that stimulus is unwound, once the recovery really gets underway, we might see evidence in inflation.
There are a couple of questions on how much this crisis showed the need for global cooperation, both in terms of policy response, of economic policy response, but also in terms of, you know, disease control, health, climate, or everything. So each, you know, there have been strong anti-globalization forces, but this shows that, you know, we're all in the same boat, and so cooperation is the way to go. So I don't know if you want to comment on that, Franziska and Ayhan.
So this is an issue we discussed extensively in the report, the need for global cooperation. There are multiple reasons for that. I think the kind of the, you are facing a pandemic, it's global. You are experiencing one of the deepest global recessions on record, and you are experiencing most synchronized recession the global economy see on record. Now, of course, there is a need to respond collaboratively. Now, so far, what we have seen, at least in the context of G20 and G7, the desire to basically provide aggressive response. And I think even if we do not say these are coordinated policies in terms of supporting activity, in terms of trying to contain the pandemic, they have been highly synchronized. Now, the question is always whether has it been sufficient? And there, I think there are serious questions. And those questions manifest themselves in different, you know, issues. One issue is still the health crisis in terms of developing vaccines, in terms of, you know, containing the crisis through coordinated measures. Obviously, more could be done. And then there is the issue of thinking through the implications of policies and, you know, how global community can help those low-income, vulnerable economies. I mentioned the debt relief initiative for these economies. We do think that more needs to be done in the context of debt relief. These economies will need more help. That help should come from different entities, including private sector, and the help should be in place for an extended period of time. Above and beyond, I think a pandemic being a global crisis teaches us that this is a moment, once again, to understand the challenges the global community faces will require global solutions. In the context of health crisis, I think the single most important message is the transparency of information when there are threats to public health and dissemination of that information to make sure we are able to contain these types of episodes in their origins. Beyond that, of course, I discussed this issue of tail risk associated with different types of events and the materialization of that events. And there, the climate change related risks are really down the road, could be very threatening. And we need to be prepared to act and act as soon as possible. In the context of trade, in the context of global integration, that basically supported incomes, that supported poverty reduction for an extended period of time. Threats to, you know, the kind of the global value chains are material. And if they basically materialize, if we see protracted decline in trade integration, protracted moderation in global value chains, there will be consequences, not just in terms of jobs, but in terms of productivity, in terms of, you know, human capital formation, and in terms of long-term growth prospects. All in all, it is necessary for the global community to have a kind of collective mind and a set of solutions mutually agreeable to to push forward the kind of the global agenda to deal with these problems.
Yeah, I think this is a very important message. We have 2 minutes left, so, and I think we covered most of the questions. So I don't know if Franziska or Nathan want to add something, but I think this sort of what, you know, this message for, you know, for multilateralism, for cooperation is a very important message.
I do want to pick up on one thing that Nathan said that keeps coming up in a lot of the discussions we have of this chat. It's this idea that there's opportunity in the disaster, or there can be if one knows where to look. And Nathan mentioned some opportunities, a lot of them related to digital, but another opportunity that comes out a lot is this GVCs. What we know from the Fukushima disaster is that after Fukushima, there wasn't a retrenching of global value chains, there was a diversification of global value chains. They just moved away from Japan, but they moved elsewhere, not home. And this may be the opportunity, even in this context. Maybe there will be a re-diversification in global value chains that some countries that are currently excluded can take advantage of, but it would take a lot of homework to take advantage of this opportunity. No? Business climates have to be improved. Governance has to be improved. Nathan also mentioned some of the homework that has to be done to take advantage of the list of opportunities that he mentioned. IT infrastructure has to be improved in order to really get benefits from the online learning and things like that. So it's a mixed bag. There are opportunities, but at the moment, really, it's really only a silver lining on a very dark cloud. Yeah.
So by the way, since Ayhan was nice to mention the ebook that I edited with Simeon Jankov, which came out this week. We have a chapter on that book exactly on this point, written by some of your bank colleagues, by Caroline Freund, Aditya Mattu, Alan Mulavcic, and Michele Ruta. And exactly, they use Fukushima to study this sort of cost and opportunity of these massive shocks. But Nathan, would you anything to add?
No, I'm fine. Thank you. Thank you.
Okay, so I think it's 6 o'clock, so we are on time. So let me just thank again Franziska and Ayhan for this presentation, but also for always pushing the boundary of policy research. What their office produces is amazing, in terms of both quantity and quality. So thanks a lot, and we're looking forward to have another event when the next report is out. And thanks, of course, to all the team of CEPR for organizing this.